Hi, my name is John Alzheimer, and I'm a credit expert who contributes to creditcardinsider.com. Today's question is, what is an APR? So an APR, APR is an acronym that stands for annual percentage rate. And an annual percentage rate is a single percentage that represents the actual yearly cost of servicing some form of debt, like a credit card, or an auto loan, a mortgage, student loan, any type of liability where it's accruing interest is going to have an APR. And the APR is also supposed to encompass the cost of fees as well as the cost of any interest. The average interest rates or the average APR is going to vary by loan type or by liability type. So for example, in the credit card world, the average APR is somewhere between 15 and 16% for a general use credit card like a Visa, a MasterCard, American Express, or a Discover. For retail store cards, which are cards that are issued with the branding of one of the stores where you like to shop, they're going to have much higher APRs. The APRs for those types of cards can run well into the 20 percentage point range, and it's generally one size fits all, which means that regardless of how good your credit happens to be, you're likely going to get that type of interest rate. Credit cards have what's referred to as variable interest rates or variable APRs rather than what's referred to as a fixed APR. A fixed APR means that your interest rate stays the same over time. Credit cards now have variable APRs, which means that they're tied to the prime rate, which is referred to as an index. And every time the prime rate changes, there's a possibility that the interest rate on your credit card is going to change. Now, the prime rate hasn't changed in many years. It's still 3.25%. But many experts believe that in 2015 it's actually going to go up. So it's very possible that the APR on your credit cards is also going to go up because it's likely tied to the prime rate. Now, interest rates and APRs for credit card accounts are only meaningful if you're actually carrying debt on the card, meaning that you revolve or roll or carry a balance from one month to the next without paying it in full. At that point, you're going to accrue interest, and that's based on the APR. If you pay the balance off in full every single month by the due date, then really the APR becomes meaningless because you're not paying interest anyways. APRs on mortgages today are somewhere between 3.75 and 4.5% for people who've got very good credit, but they can go as high as greater than 6% for people who have poor credit. And the APR for a mortgage loan is generally calculated based on your credit reports, your credit scores, and other wealth metrics like your income, the amount of savings you have and reserves built up, and also the collateral value of the house. So things that you are not even thinking about when it comes to credit cards are considered in mortgage lending because it's a different type of loan, usually a much higher dollar loan. For auto loans, interest rates or APRs can be actually as low as 0%. There are some financing sources, generally what's referred to as a captive, and a captive is the financing arm of the manufacturer, like Ford Motor Credit, or Toyota Motor Credit, or Honda Finance. Those guys generally finance cars built by their manufacturer. Because they're the captive auto lender, they're able to offer much more aggressive interest rates, and in some cases, if you've got good enough credit, that interest rate can be as low as 0%, because they want to move a unit off the lot, get it on the street, so they're actually willing to let you have essentially free money in order to sell the car. They're making margin in the sale of the car, of course, so they have another way to fall back on revenue, where most lenders who are lending money for car loans are falling back on nothing other than just the APR or the interest rate. APRs are set in almost all cases based on credit risk, or the risk of the lender doing business with you. So things like your credit scores, and the information on your credit reports, and in the mortgage environment, wealth metrics, and collateral value, those things are all kind of glommed together and determine the overall risk of the lender doing business with you. And that's how they're going to determine the APR. The APR is the way that they can subsidize the risk of doing business with you by making more money from the entire group of people who have similar risk profiles. If you've got really, really solid credit, you're going to get a very aggressive APR. If you've got mediocre to poor credit, you're going to get a not so aggressive APR. And if you've got bad enough credit, then there isn't a high enough percentage rate that they can charge you to subsidize the risk of doing business with you. You're just simply too much of a hot potato. If you have any other questions pertaining to credit or other financial topics, please submit them to creditcardinsider.com. Thanks for watching and have a fantastic day.